Hello, everyone. This is Dan Passarelli, and I'm really super excited to be here filling in for Tony. Thanks for allowing me to be your host today. My name's Dan Passarelli, and today we're going to talk about trading option Greeks. I've got a lot to say on this subject. So what do you say we just sort of dig in, shall we? Before we get started, I need to point out options are not for everyone, and you should read characteristics and risks of standardized options before trading. You can get a copy of that by calling 1-888-OPTIONS. So what if you could estimate how much you can make on a trade better, so that you could select strategies with a better risk reward? Would you trade better? What if you could estimate your likelihood of success on every one of your trades? Would you trade better? What if you could know how much you make or lose on every one of your trades as time passes on any position? Would you be able to manage those trades better? Would you be able to select better trades? Well, these are the things that the Greeks enable you to do. The option Greeks are metrics that help option traders make better decisions. I'm very passionate about the option Greeks. If my bio is somewhere around there, the first book that I wrote is called Trading Option Greeks, and all the material that we're going to cover today comes, well, pretty much right out of that book. So the option Greeks, they measure the price influences on options, right? Because like, if you think of, like, for those of you who don't yet trade options, or maybe have been for a little bit, if you consider just like trading stocks or trading futures, those are what a friend of mine used to call linear products. He worked at one of the really big trading companies in accounting. He would refer to them as linear products because stocks and futures, they go up, they go down, and that's it, right? The supply and demand pressure on up and down, like, that's all that affects their value. But options are a little bit different. They're a little bit more nuanced. There's a little bit more to them. They're not just purely linear. There are things that influence the price of options, one being direction, of course, but one also being time passing. As time passing, options get worth a little bit less every day, right? One is volatility, which we're going to talk more about later in this presentation. Interest rates, even dividends. So the Greeks helps you with the vast majority of these things, the biggest influence on all your option positions. So we have the four main Greeks: delta, gamma, theta, and Vega. I'm going to talk about them for probably the next 30, 40 minutes or something like that. And then we're going to open it up to questions. Everything sound great? Sound great so far? Let me know that you can hear me, and let me know that you're excited to hear about what I have to say here. We got hands raised. Oh, holy moly, you guys are excited. Great. When you're excited, I'm excited. 20, holy moly, so many people raising their hand. Okay, well then let's dig in and let's get started with the first Greek, arguably the most important, I would say, or at least I would say it's the one that typically with most option trades has the biggest impact on your profitability. So yeah, I guess it is the most important then, right? Here's what delta does. Delta estimates how much an options price will change relative to a change in the stock price. So this one is the directional influence, right? If the stock, or we could be talking about an ETF or a holder, or those of you who are in commodities, we could be even talking about futures options. It measures if the stock or whatever the underlying goes up by 1 point, by $1, how much does that call go up by? Because we have to know that. If we're going to trade strategically, intelligently, and make good decisions on planning our management and planning our exits and all that, we need to know the answer to that question. And when you think about it, what delta really is it's a measure of both leverage and protection. Because if I own 100 shares of a stock and it goes up $1, I make $100. If I own a call and it goes up $1, how much do I make? If it goes down, how much do I lose? If I want to get some leverage, how many of these calls do I have to buy to get that directional sensitivity that I want? Now, this is sort of the classic definition of delta, but really, there's actually 4 different definitions of delta. The first one is it's the rate of change of an option's value relative to a change in the underlying stock price. All right. And that's the one we were just talking about. It simply says the stock goes up $1. How much does the call go up by? How much does the put go down by? Definition 2 is sort of the mathematician's definition. Now, I'm not a mathematician by any stretch of the imagination. I do vaguely remember college calculus, and this is what that is. The derivative of the graph of an option value relative to the stock price, right? So we've got option value here on the y-axis, stock price on the x-axis. What is the derivative of that graph? Now, for those of you who barely remember calculus, college calculus like me, don't get super hung up on that one. All it really is just a mathematical restatement of definition 1, right? Let's take definition 3. Now, this is this is a very, very useful definition. It's the equivalent of underlying shares represented by an option position. And if you think about it, let's say I buy a call in, I don't know, Apple, right? And it has a 43 delta. If the stock goes up by $1, I make 43 cents, right? That's definition 1 and definition 2 sitting right here. If it's a 43 delta stock goes up by $1, I make 43 cents. But if you think about it, if I owned 43 shares of Apple and the stock went up by $1, I'd make 43 cents, right? $43 of actual money, right? So in a way, this is also a restatement of definition 1. Now, I like this definition, definition 3, because it really helps me to understand my sensitivity in a very direct sort of non-ambiguous way, right? If I think about what my position delta is as like effectively how many shares I have of the underlying, or more like if I had that many shares of the underlying, right? That helps me really think very, very clearly. Because what happens sometimes is, some people end up putting on a position and it's like, oh, well, I usually do 5 calls, right? But maybe they don't think about, well, 5 calls in Ford is a lot different than 5 calls in Amazon, right? Because they move differently, right? Because stocks move in percentages. So when I think about it as this is like effectively the shares represented of an option position, it's effectively like the sensitivity of me having that many shares in the underlying. Like I know if I had 43 shares of Ford, okay, I'm probably not going to make or lose a whole bunch of money today. If I had 43 shares of Amazon or Google or something like that, I could stand to make or lose a whole lot of money that day, right? So I love that definition. And I basically got that definition when I was a market maker on the CBOE trading floor, because I would hedge all my positions to get what we call delta neutral. And we might be able to talk about that either a little bit later today or in one of the other webinars that I'll be doing over the next month or so with OptionsPlay. Now, the fourth definition is what I like to call the trader's definition. Now, I've got a little note here. I don't do a lot of, little footnotes or anything, but this one requires one. I want to point out that this definition is not necessarily 100% mathematically correct, but it's still a very valuable definition. And every single trader that I know, that I've ever known, uses delta in this context. So I think it's important to talk about. Delta can be thought of as the estimate of the likelihood of an option expiring in the money. Now let's talk about that a little bit. We've got some rules of thumb when we think about delta. If we're talking about an in the money option, whether it's a call or a put, the delta is going to be greater than 50, okay? We'll skip down to bullet point 3 here. If we're talking about an out of the money option, whether it's a call or put, the delta is going to be less than 50. And that leaves us with the at the money. If an option is right at the money, the delta, whether it's a call or put, is going to be roughly 50. Now, that's not 100% exactly correct. Typically, if a stock is right at the money, the calls will have a little bit more than a 50 delta. The puts will have a little bit less than a 50 delta. But these are really great rules of thumb if you're just learning this stuff. Now, back to that trader's definition, the way I like to think about this, the way that it can help me remember this, right? And maybe help you remember this. If I have an option that's already in the money, it's got a head start at being in the money at expiration, right? If we think about stocks as like a log normal distribution, right? If you think about stocks as a log normal distribution, there's like almost a 50-50 chance of it going up or down roughly. Not exactly, but pretty much. So if the stock's already in the money, or if the option is already in the money, it's got a head start. It's got more than 50% of a chance of being in the money at expiration. So consequently, those in the monies will have a delta bigger than 50. If the option is already out of the money, it's got a head start of being not in the money at expiration. So it'll have a likelihood of expiring in the money of less than 50%. Its delta will be less than 50. And if it's right at the money, it's about 50-50, and thus at the money options will be roughly 50-50. Now, all of this said, if we think about what I like to call put call pairs, right? So like if I'm talking about the November 5th 67 calls and the November 5th 67 puts, they're a pair, right? They're on the same line, if you will, on the option chain. If we add up the absolute values, which is basically forget about any negative or positive signs that our broker might have. If we take the value of each of those are going to add up to pretty close to 100. And that kind of makes sense in this context too, right? Because if the 67 call has a 43% chance, or 43% chance of being in the money, the 67 put will have a 57% chance of being in the money, because it's either above or below that strike. So one's either in the money and the other one's out of the money, right? Okay. Any questions so far? No, you know what? I'm going to hold all questions till the end. That's the better way to do it. Then we can make sure that we have time to get through everything. At the end of this presentation, though, I'm going to take everybody's questions. So this is basically how I set up my option chain. Truth be told, I removed the columns of volume and open interest for this presentation to have fewer numbers on the screen. But these, anytime I look at an option, I have implied volatility, delta, theta, vega, and usually gamma. And then, of course, the bid-ask spread, both on the call side and the put side. Those of you who use Thinkorswim, that's what we're looking at here. We're looking at the Thinkorswim platform. It's a screenshot of it. Prices not current. So let's see here. Let's take a look at the 147 calls. Maybe I think that this stock, Apple, in this static example, again, price is not current. This is just a screenshot that I took a couple days ago. Maybe I think Apple's going to go up, right? And if I think that Apple's going to go up, I might want to buy calls. But which call should I buy? Well, that depends on a few things, right? If I want a position that acts a lot like owning shares of the stock itself, but I just want that limited risk that comes with owning a call, I might buy maybe the 140 calls, right? If I buy the 140 calls, that has about a 75 delta. That means if Apple goes up $1, I make 75 cents. If it goes down $1, I lose 75 cents. It's like I own 75 shares of Apple as far as my profitability is concerned. Now, maybe though, maybe I want to risk less. And if I do, maybe I want to get like, I want to know if I buy a higher strike, less expensive call, how much sensitivity do I get by owning that? So maybe I might buy the 149 calls and I'd have a roughly about a 28 delta. Okay. Well, those are two very different positions. One acts like almost 75 shares worth of stock. One acts like about 28 shares worth of stock. I would pretty much have to buy 3 of the 49 calls in order to have a similar position as one of the 140 calls, right? But here's the thing, if I bought 3 of the 149 calls, that would only cost me $3 and what does that come out to? $3.50 instead of $6.15. So all of a sudden, some light bulbs kind of start to click. I can, if I understand how delta works, I can end up like constructing different sorts of positions that help me achieve very, very specific goals. Another thing to consider with all the Greeks, but let's talk about delta right now, is what if I bought the 144, 146 call spread, right? Well, if I bought the 144 calls, I'd be getting long about 56 deltas. If I sold the 146 calls, I'd be getting short about 44 deltas. I'd have a position net long about 11 deltas. Now, there's a lot more that kind of goes into this. First of all, let's keep exploring delta and let's think about how delta changes. So delta itself has dynamic inputs. As moneyness, which is the stock price relative to the strike price, as that changes, delta changes. As time passes, delta changes. And as volatility changes, delta changes. So as far as moneyness goes, options that get more in or out of the money, delta logically changes, right? That's that slide we were just looking at, this one right here. Obviously, if the stock goes higher or lower, the option gets more in or out of the money, so the delta logically has to change. That change is measured by gamma, which we'll talk about next. As time passes, delta changes. As time passes, in or out of the money option deltas move away from 50. In the money options get closer to 100. Out of the money options get closer to 0. That's important to know because as my position changes, I need to know how my directional sensitivity changes. As volatility changes, and those of you who are a little bit newer to the concept of volatility, we're going to talk a whole bunch about that in just a few minutes. But as volatility changes, an increase in volatility will cause the deltas of all options to tend towards 50. A decrease in volatility tends for all options deltas to tend away from 50. Specifically, a decrease in volatility makes in the money options closer to 100 and out of the money options closer to 0. And as interest changes, as the interest rate rises, at the money call deltas get bigger and put deltas get smaller, and vice versa. As the interest rate falls, at the money call deltas get smaller and put deltas get bigger. Now, I promised, or some might say threatened, that I would talk about gamma. So here we go. Remember, we were just talking about how as the stock goes up or down, the deltas change. Well, we want to be able to measure that too, right? Good trading is never about guessing. Good trading is about measuring and using those metrics to make better decisions. So in order for me to know how much my delta changes as the stock goes up or down, I look at gamma. Gamma is the rate of change of an option's delta given a change in the price of the underlying security. And it's stated in delta terms. So if the gamma is 0.04, right? In fact, let's look at a real example here. Oops, that's not the right way to do that. Thought I had my trading platform open, which I don't. So let's just use this hypothetical example. If the delta, if the gamma is 0.04, what does that mean? That means if the stock goes up, the delta increases by 4 deltas. If the stock goes up by $1, the delta increases by 4 deltas. If the stock goes up $2, the delta increases by 8 deltas. And of course, if the stock goes down $1, the delta decreases by 4 deltas. As far as gamma goes, I do have it in my option chain, especially for this presentation, but truth be told, I don't look at it that much. Now, does that mean it's not important? No, gamma is very important, but knowing the exact value of gamma is less important than knowing the general concept of what gamma does. First of all, gamma is greatest for short-term at-the-money options, whether calls or puts. That means that the delta changes the most when the stock goes up or down for short-term at-the-money options. The other things you need to know is that long options yield positive gamma and short options yield negative gamma. Now, what exactly does that mean? Basically, what that means is positive gamma means that when the delta changes, it always changes in your favor. With negative gamma, when the delta changes, it always changes against you. It's always adverse. All right, so let's think about that. Let's say I buy a call. Let's say I buy a call for $3 and it's got a 50 delta right at the money. Well, if the stock goes higher, if I own that option, I have positive gamma. If the stock goes higher, that means my delta gets bigger because it's more in the money. That's what positive gamma means. That means I'm making money on that call because of the delta, but the delta is getting bigger, so I'm making money at an increasing rate. And if I own that call and have that positive gamma, if the stock goes down, my delta gets smaller. So I'd be losing money on that delta, but the delta is getting smaller, so I'm losing money at a decreasing rate. It's always beneficial. Now, those of you who trade like time spreads and credit spreads, maybe cash secured puts, you've seen and felt the effect of negative gamma, right? Negative gamma is the opposite of that. When, like, you've noticed sometimes, like maybe if you have a butterfly or a time spread or something like that, if the stock moves just a little bit, it doesn't really hurt you that much. But if it moves a lot, that's where you can see some pretty leveraged losses because the delta is changing against you. If the stock goes higher, your delta gets shorter. If the stock goes lower, your delta gets longer. All right. Now, sort of the inverse of gamma, because gamma, like if you're long options, gamma benefits you. If you're short options, gamma hurts you. Theta is just the opposite. It's the other side of the coin. All right. So first of all, here's how theta works. Options lose value as time passes, all else held constant. We're assuming, no directional influence, stock doesn't go up or down, but if time passes, the option loses a little bit of value. This is called time decay or erosion, and it's measured by theta. So The definition of theta is the rate of change of an option's value given a change in the time to expiration. Basically, as each 1 day passes, theta will tell you how much the option decreases in value. Now, first of all, let's call attention to this. Is it good or bad that options decrease in value? It depends, right? If I own an option and it decreases in value, I lose. If I own anything and it decreases in value, I lose. But if I'm short an option and it decreases in value, I make money, right? So there are a few important rules of thumb when it comes to theta. First of all, near the money options have less decay initially, and the theta gets bigger as expiration approaches. In the money and out of the money options have a more linear rate of time decay. Theta values are typically based on a 7-day week, which is actually really important. How many of you who have traded for a while, but maybe haven't used the Greeks very much, how many of you have, like, let's say, owned a call on a Friday and the stock goes up, but your call didn't go up in value, or maybe it even went down a little bit? And you're left scratching your head thinking, my call's up, but I mean, you know, or the stock is up, but my call is not showing that. Why is that? Well, it's because of this little nuance of theta that's really important to understand. If we look, and here, let me skip ahead for 1 second. If we look in the theta column here, and let's say we look at these 145 calls, the theta is minus 0.100. Well, what does that mean? That means as each 1 day passes, this option loses 10 cents, all else held constant. It might make or lose because of delta, but it will lose because of theta. When I say lose, I specifically mean decrease in value. If you're long them, that's bad. If you're short them, that's good. Okay, so that's how we measure the time decay, but what happens on Saturday and Sunday? Because this theta figure is based on a 7-day week. Well, the theta comes out as the market takes it out. It doesn't necessarily, like, it's not like at 2 o'clock every day, somebody rings the bell and everybody makes their options worth less by 10 cents, right? It just sort of happens naturally. If it's a slower day, the order flow will come in and there'll be more selling, and the market makers will consequently lower their values by taking the day out. But when we come to like Thursday and Friday, everybody knows there's no trading on Saturday and Sunday, but there is theta. So they do what's called taking the weekend out. They move their theta, or they move their days to expiration in their models ahead by 1 day to get on Saturday's days, 2 days to get on Sunday's days. And a lot of times by the end of Friday, they're already trading on Monday's days. All right, now what else can we use theta for? Well, first of all, let's say I have some calls. Maybe I bought 10 of these 145 strike calls, right? I think, you know, in this hypothetical scenario, I was thinking that Apple would go up, so I buy 10 of these calls at $2.82. Well, what happens if it takes longer to go up than I thought? I know that for every dollar Apple goes up, the calls make 50 cents because Delta tells me that. But if it takes 5 days for that to happen, I'm going to lose 5 days of theta. So 5 times 10 is 50 cents. So theta can kind of help me make better decisions as to what delta to use, as to how to construct positions based on my timing. I want to make sure that if this is a delta play, a directional play, that my time horizon is conducive where I'll make enough money on delta to cover what I lose on theta. Other things I can do is I can plan my positions accordingly by doing what's called hedging off theta. So maybe instead of buying the 145 calls and having 10 cents a day in theta, I could buy the 145 calls and sell the 149 calls. There, I'm losing 10 cents a day on each option. But if I sell these, I'm making 8 cents a day on each option, right? Because the ones I'm long get worth less by 10 cents. That's bad. The ones I'm short get worth less by 8 cents. That's good. So I was able to hedge off literally 80% of my theta by instead doing a spread. Now this I might want or I might not want. It depends on how fast and volatile of a move I'm expecting. We're going to talk about that more in just a minute as well. It's also a way to optimize income trades. Let's say I'm considering between, I'm considering between a time spread, a butterfly, and an iron condor, right? I want one of these neutral trading strategies. Well, which one do I pick? One of the criteria that goes into that decision is, well, what is the theta of each? Because when you're trying to profit from a position, I mean, from anything really, you want to profit the most that you can. So you want to get the biggest theta. All these income trades like time spreads, butterflies, and iron condors, they're all time type strategies. They all make their money from time passing, from theta. We want to get the biggest theta we can get. This will guide which of those three strategies we pick, which strikes we pick, as well as which expirations we pick. If I want to get a bigger theta with the same strikes, I will use shorter term options, especially if the options I'm selling are near the money, because I'll get a bigger theta. So we're able to select our trades better, to manage our trades better, and to optimize our strategy selection better. Just like with delta, there's dynamic inputs when it comes to theta as well. As moneyness, time, and volatility change, theta changes. Moneyness, that's again the stock going up or down relative to the strike price, getting more in or out of the money. Well, I already kind of talked about this. As options get more in or out of the money, theta changes because near the money options have the highest theta, and in or out of the money options have the lowest theta. So as we get closer to the money, the theta gets bigger. As we get farther from the money, theta gets smaller. As time passes, the at the money theta gets bigger. It increases. This becomes extremely important. A little tip for those of you who trade butterflies. Butterflies, in my opinion, are really only good to trade if they're less than 10 days to expiration. In fact, probably less than 5 days to expiration. Why? Because when there's 14, 30 days to expiration, something like that, the theta, which is the whole benefit of the trade, is extremely small, meaning you barely make any money as each day passes, but the break-evens are static. If there's a big move, you can lose a lot, technically by negative gamma, right? So we always want to keep butterflies a very short time horizon. In the money or out of the money, thetas tend to remain pretty much constant as time passes. Sometimes they can even get smaller or bigger. With volatility, an increase in volatility will cause the thetas of all options to get bigger, and a decrease in volatility will cause the thetas of all options to get smaller. Now, I've talked a fair amount about volatility so far, and there's a good number of folks in the room here, and I see that there's some questions. I'm going to take every single person's question, but it's going to be at the end of the presentation. So I'm not ignoring you. Hang in there, stay pat. I'm going to take it. Okay. We're going to need to talk about volatility. Those of you who are really new to options might not be familiar with volatility at all. Some folks who have traded options might still not be that familiar with volatility. But if you've traded options long enough and you haven't lost a lot of money, you figured out that there's this component to option prices called volatility. But it can be a little bit complicated because the words get in the way, frankly. The thing is there are two types of volatility when we talk about option trading: realized volatility and implied volatility. Now, realized volatility, let's not get fancy or anything right now. Let's just talk in common, everyday layman's language. Realized volatility is a measure of how much the stock has moved around lately. That's it. In plain old English, that's what it means. If you see a stock where the chart is all over here and it's down, it's up 50%, and it's down 30%, and it's just crazy, that's high realized volatility. If you see a stock where it barely moves at all, it's been in a 5% range for the past year, that's low realized volatility. Now, here's how this actually works mathematically. Realized volatility is the annualized standard deviation of the underlying stock. Basically, what they do on most platforms is they take the last 30 closing prices and they find the standard deviation of those last 30 closing prices, and then they annualize it to make that 30 days representative of a 1-year period. And they do that for a couple reasons. One is to compare apples to apples. If we're looking at a short-term one and a long-term one, we want to have something constant. So we want it to be annualized. Now, look, we don't sit down and take out a calculator and figure out the realized volatility. It's there on most options-friendly trading platforms. Realized volatility is also called historical volatility. So if you've never heard of realized volatility, but you have heard of historical volatility, those are complete synonyms. Now, frankly, realized or historical volatility, that's the easy one. We already, our brains already know what that context of the word volatility means. Is it this or is it this, right? Implied volatility is where it gets a little bit tricky, okay? But it's really not that complicated. The lay definition, plain old English, is implied volatility is how cheap or expensive the options are. That's it. How cheap or expensive the options are. Now, you might look at that and you might think, well, that's kind of strange. Like, what does volatility have to do with how cheap or expensive the options are? I don't really get it. Well, consider that with each of these things, direction, time, and volatility, when we're measuring the impact of them, we're holding the other ones constant. So obviously, options get worth more or less as the stock goes up or down. They get worth less as time passes. But if we hold those two constant, options can still become more expensive or cheaper because of supply and demand, right? Everything is subject to the laws of supply and demand. If a big trading firm comes in and buys 5,000 calls in some stock, that's going to drive the price of those calls higher, whether the stock goes up or down, time passes, or anything. So how does this word volatility fit into that? Personally, I think it's a bad word for this. I don't think we should call it implied volatility, but that's what everybody calls it, so that's what I'll call it too. But it stems from this idea that the economic purpose for options is hedging or speculating on the underlying using the option as a proxy, right? So why would I buy options for a hedge? Well, I would buy options for a hedge if I think the stock is going to potentially have a lot of volatility in the future, right? If I own a stock and I want to hedge against an event, if the stock is just like really static and there's no news coming out in the future and I don't think it's going to be volatile, I probably wouldn't feel like I need to hedge it. But if the stock is like very volatile, or there's news coming out in the future that might make it more volatile, I'm much more likely to want to hedge, to need to hedge. I'm much more likely to buy options, buy puts to protect the position, or buy calls, which basically also protects the position, rather the cash position, right? Because I can buy a limited risk call instead of the full value of the stock. If you think about it, either one's really a hedge, right? But I'm much more likely to buy options when I think volatility will increase. That's the theory anyway, and that's why we call this implied volatility. It's interpreted as the market's estimation of future volatility of the underlying, or the volatility implied by option prices. Now, the way this really works is that there's an option pricing model that basically takes into account all the things we talked about: direction of the underlying, like the stock price and the strike price, time passing, interest, and volatility. So the way they come up with volatility is implied volatility, and I'm looking at the textbook definition shown on the screen here. Implied volatility is the volatility figure that when entered, excuse me, one second, let me grab a drink of water. The volatility figure that when entered into an option pricing model yields a theoretical value reflecting current market prices. Now, shoot, that's a mouthful. That's hard to remember, seems complicated, so don't worry about it. All you need to know is the higher the level of implied volatility, the more expensive the options are. The lower it is, the cheaper they are. All good? Raise some hands if we're all good here, if we're all on the same page. Give me some hand. Oh, holy moly. Like racking up points over here. Awesome. Great. You guys are awesome. You're catching on. Anybody who this is really new to, or there's just some sort of mental block and maybe you don't get everything yet, that's okay. We're doing a Q&A coming up here in about 10 minutes. So this is a little bit obscure, this idea of volatility, because I know that as volatility goes up or down, the price of my option position goes up or down, but by how much? You know, like how much is a volatility point worth? It seems so esoteric. It seems so just removed from how our brains might already be predisposed to work, right? How much do I actually make or lose if volatility goes up, if implied volatility goes up or down 1 point? Well, that, my friends, is measured by Vega. Vega, as implied volatility changes, all option positions make or lose money. This is what Vega measures, and it helps traders understand the financial impact of implied volatility on their positions. Specifically, we can say Vega is the rate of change of an option value relative to the change in implied volatility, all else held constant. And it's measured by dollars and cents. We'll look at that on the screenshot of the option chain in just a second. Now, a couple of rules of thumb with this one. The put call pair that I was talking about, right? The November 5th, 67 calls and puts, right? Same line. They will have similar Vegas. A lot of platforms will show them as identical. Short-term options have lower Vegas than long-term options. So basically, as time passes, Vegas gets smaller. Implied volatility moves more in short-term options than in long-term options. So let's explore some of these things here. So first of all, here we're looking at these are 14-day options. If we were to look at the 145 calls, 7 days options, and 21-day options, the Vegas will be different for the same strike with different time horizons. Vegas gets smaller as time passes, but the 7-day options, if implied volatility changes, it'll change more in the 7-day options. And typically, even though the Vegas are smaller in short-term options, because the implied volatility moves so much more in the short-term options, they are more affected by changes in implied volatility because implied volatility changes more. So let's just go back to our original simple example. Hey, in this hypothetical example, I think Apple's going to go up. So I decide to buy 10 of the 145 calls. Okay. Well, what if implied volatility falls? What if a big trader comes in and sells a lot of these calls? What if it goes down from 24.63, 1 full point, to 23.63? What happens to my call position? Well, if it falls by 1 percentage point, the calls will decline in value by 11 cents, 11.3 cents. That means if these are 277 bid, they'll be 266 bid, and these will be 271 offer. I might make money as if the stock goes up, or lose money if the stock goes down. I might lose money as time passes, but if volatility goes down, I'm going to lose money. What if somebody comes in and buys a bunch of options and it forces the volatility from 24.63 to 25.63? Well, then my calls will go up in value by 11 cents. Right? So like you might think, well, why does this matter? Well, it matters because even if, you know, you're just trading very basic directional trades with options, just buying calls, you will still make or lose money based on implied volatility. So you know what you ought to consider? You ought to consider putting this information to use to make it an asset instead of a liability, right? As traders, we don't like surprises. We don't want to wonder, hey, why did my stock go up, but my call value went down, and it wasn't theta, time didn't pass. We see this all the time with earnings, right? When do people really like to hedge? Well, right before a big volatility event. So what a lot of people will do is they'll buy a lot of options right before earnings, or even the week or two leading up to earnings. The day before earnings is when implied volatility can be really high. And so sometimes more novice traders might buy calls because they want to speculate on the stock going up after earnings. And sometimes they're right. They guess right. The stock goes up a lot, but their call goes down. Why? Because when earnings comes out, the volatility collapses because the people who had the options to hedge, they don't need them anymore. They sell them out because the move either happened or didn't happen, and they don't want to hold them and lose money because of theta. So I might choose to select different strategies. If implied volatility happens to be really high, instead of buying a call, one thing I can do is, well, maybe I can buy these 145 calls, but sell the 149 calls. I can hedge off my volatility risk. If I buy the 145 calls, I get positive 11 cents of Vega, but I get negative 9 cents of Vega. I hedge off, 9 cents. It goes from, 11 if I just buy the calls, down to 2 cents if I do the spread. Then if implied volatility goes up or down, I don't make or lose as much. It's a much more strategic way to trade. I can also use it to get an edge on options, to select better positions. If I do a volatility analysis, which we don't have a whole lot of time to get that deep into right now, but it has a lot to do with looking at volatility charts and such, which maybe we can talk about in the Q&A session if there's time. If I look at the volatility and I believe that volatility is cheap, I probably want to do option buying strategies because maybe volatility is more likely to go up. What we tend to see with volatility is what's called reversion to the mean. When it's cheap, it tends to go up, and when it's expensive, it tends to come back down. So when volatility is low, we tend to want to do option buying strategies, buying calls, buying straddles, debit spreads. When volatility is expensive, is high, we tend to want to do volatility selling strategies, income trades, iron condors, butterflies, maybe calendars, credit spreads, that kind of thing. So it guides us in expectations, it guides us in trade management, and it guides us in strategy selection. There's some dynamic inputs when it comes to volatility. As options get more in or out of the money, Vega changes because near the money options have the highest Vega. In the money and out of the money options have lower Vega. That means as the stock goes up or down, my sensitivity to implied volatility changes as well. As time passes, Vegas decrease. Remember I said shorter term options have smaller Vegas? As volatility, and this is a little bit meta here, right? Volatility affects volatility. An increase in volatility will cause the Vegas of all options to get bigger, and a decrease in volatility will cause the Vegas of all options to get smaller. Now, we just talked about a whole lot, right? And if Greeks were brand new to you, maybe it seems overwhelming, but don't worry, it's really not. Spend some time learning more about the Greeks, right? Because they're really very important to you. The most important thing that you need to know once you have the definitions of these Greeks down pretty well is that the Greeks all move independent of each other, right? The stock can go up or down today or next week or a year from now. It's independent of time passing. Time passes, and that doesn't matter if the stock goes up or down or if volatility changes. Volatility changes regardless of time passing. So we need to monitor each of them individually and use that as sort of a holistic forecast, if you will. Many of us, when we start out in trading, we start out trading those linear products, right? Stocks, ETFs, maybe futures. We simply forecast by looking at technical or fundamental analysis and kind of call it a day. With option trading, we need to forecast with technical or fundamental analysis, but also with a time horizon and plan our expiration around that to maximize our theta. So we put on better positions. We need to think about, is implied volatility high or low, because that'll guide which strategies are better, which have better risk rewards, right? And these are all the things that make us more successful traders, right? So here is what I'm going to do now. I'm going to take all of your questions. So let's start out. I see that I've got a couple here in questions, and I see there's some stuff in chat. I'm going to start out looking at the questions box, then I'll move into chat. I think it'll probably be easier if everyone puts their questions in the Q&A section. So Wallace says this. Wallace says, oh, some traders use the trader's definition of delta divided by 2, estimated probability that where the stock price will be at by expiration time. Is this delta divided by 2 a good estimation using delta to predict the stock price? Well, no, Wallace, it's really, I mean, it's just sort of a rule of thumb. And so don't get super hung up on using delta as an estimate of the likelihood of an option expiring in the money. And because it's not really mathematically accurate, like, I don't want you to get very hung up on using it, and definitely not making it even more complicated by dividing it by 2 or 1 minus delta divided by 2 or whatever. All right. So yeah, don't get super hung up on it. Okay. Jake says, hi, Dan. Tony always indicates that the OptionsPlay platform does the optimum calculation for us, right? I'd like to see an example based on delta, gamma, theta compared to the platform. Right, Jake, here's what I don't want to do. I don't want to get on the platform and kind of fumble around and try and find my password and all that, right? Because I don't have the platform open. I don't like to do a lot of live stuff like that in these presentations, but here's what I can tell you. The first thing that I want you to get good at is all the things that I just talked about, as far as using the Greeks to find the optimum or optimal position, right? The one that has the best risk reward, the one that has the best probability of success. I love the idea of you drilling down and exploring the Greeks well enough that you can do that on your own. But then, yes, you're 100% correct. The OptionsPlay platform does make that super easy for you. I don't want that to be something that holds you back from learning on your own. But you know, it's a really nice shortcut to be able to use a great platform like OptionsPlay. Tarek says, how do you put all this together in making a trade? Great, let's look at that. So let's look at, I don't know, what kind of trade might we be considering? Well, here's what we do. We don't start out with what trade would we like to do we? We start out with what's our forecast, and then we figure out which trade helps us to profit from that forecast with minimal risk, right? So let's say this. Let's say I believe that over the next 7 days, Apple will fall from 144.84, $5 down to about the 140 range. Okay. What is the best way to make that trade? If I think it's going to fall to 140 over 7 days, wait a minute, there's something else that I need to put in my forecast too, isn't there? Implied volatility. Typically, when stocks fall, implied volatility goes up, and when stocks rise, implied volatility goes down. So if I'm right, implied volatility is probably going to go up. What is the best way to make this trade? Well, I'm probably going to, well, I might be sticking to the put side. The other thing I want to consider is implied volatility high or low now. Let's say we estimate that implied volatility is a little bit high right now. What do we know about that? First of all, we know that options are expensive. We know we probably don't just want to go out and outright buy options, right? We know that we'd probably want to spread off risk, do some sort of spread. Now, especially considering that if we're only expecting it to go to 140, if we sold, you know, for those of you who are familiar with debit spreads, if we sell the 140 puts and it does go to 140, we're not leaving anything on the table. If we thought it was going to go to 130, we wouldn't be selling 140 puts, right? So first of all, that's one great way to hedge off a lot of our implied volatility risk, right? Because our Vega goes from 11 if we just buy the 144s to 2, because we have positive 11 Vega and negative 9 Vega, so that now we're left with positive 2 cents of Vega. We also want to consider which expiration we have. In the static image, all I have is the 14-day, but I might say, hey, like if I buy this spread because I want to buy the spread because to hedge off Vega, what is the theta of it on the 14-day expiration versus the 7-day expiration versus the 21-day or 28-day expiration? Then I might also say if implied volatility is really, really high, maybe that's not even ideal because I still have some positive Vega. And as the stock falls, I'm going to be moving closer to my short option, which will actually end up giving me negative Vega. And if implied volatility rises, then I'm going to end up in a situation where rising volatility could hurt me. So maybe what I could do is sell a call credit spread instead. Sell the 146 calls and get short 11 cents of Vega, buy the 149 calls and get long 9 cents of Vega. I'm actually short 2 cents of Vega. That's good if implied volatility is high and we think it's going to come down. I can make money on direction because the call credit spread will have a negative delta, on time passing, and on implied volatility falling. I'm making money 3 out of 3 ways if I do that. So that's one way to put all this together. And I mean, I could come up with 100 different ways, but that's one way. Very good question, by the way, Tarek. Anonymous attendee asks, how do you tell whether implied volatility is high or low? Right, that one's a little bit out of the scope of this presentation, but great news for you. In 2 weeks, if I'm not mistaken, I'm doing a presentation on using some of this data, including implied volatility, to get an edge on every one of your option trades. So make sure you attend that presentation. I'm basically going to answer that question in 2 weeks in a lot of detail. That's going to be really great. Good question. But in short, it involves using a volatility chart and doing a volatility analysis. Asok, sorry if I pronounced that incorrectly, I apologize if I did. What is a good textbook on actually using the Greeks in trading? Well, to the best of my knowledge, there's only been one textbook written on the Greeks, which happened to have been written by me. Definitely not trying to plug my own book, but I spent a year writing it. It's now in its 2nd edition. It's been called the Bible of the Greeks, published also in Mandarin Chinese, or simplified Chinese rather. So it's called Trading Option Greeks. It's a great source if you want a book on it. But coming back and reviewing this webinar also, because I did hit the record button, it is being recorded, is not going to hurt either. You know, I really spent a lot of time going over each one of the Greeks in great detail. Steve, hi Steve, how are you? Steve says, at the money SPY options with only a couple of days to expiration, historically are several IV points lower than 30-day at the money options. Is this simply a reflection of market demand, or is there something else that depresses the near dated options? Yeah, man, Steve, I could talk a lot about this. Those who trade the volatility complex like VXX or VIX options, whether it's the SIBO listed ones or the ETF VXX, you see that all the time. What they call the term structure of volatility in the different expirations of those comes into play and really has a lot of implications for how VXX is priced and how it has a decaying value because of what is called the contango, which is in a roundabout sort of way what you're describing, where you see further out options having a higher value than shorter term options. And I mean, there's a lot to this, but basically the way that I like to think about it is when there's less time between now and expiration, there's less stuff that can go wrong. And so I think that a lot of people just simply like to buy longer term options for longer term protection because there's more uncertainty the further out in time we go. That's a pretty good part of that answer. But yeah, like you totally are observing something factual And great job and kudos to you, Steve, you know, just for recognizing that. Christopher says, can we get the slides of your excellent presentation? You will have to talk to the good folks at OptionsPlay. I don't know if it's customary to do that, but if it is, then you'll be able to get it from them. So yeah, definitely email into your contact at OptionsPlay, and they'll be able to answer that question. Okay. Jose says, can you please define high or low volatility number wise? Oh yeah, I love this question because it's relative. Okay, it's relative. One stock that has a 25 volatility, that might be historically high for it, but for a different stock, a 25 volatility might be historically low for it. So it's all very relative. What I like to do is when we look at like a volatility chart, which I look at on Thinkorswim, it'll graph out like a 30-day option, right? And it'll say, okay, the implied volatility went higher and then it went lower, and you literally get a graph of the implied volatility over time. So that is a great way to look, because remember I said that there tends to be this reversion to the mean. When implied volatility gets low, it tends to go up. When implied volatility gets high, it tends to come back down. Well, when implied volatility is near the low of the 6-month period, it's low, right? And that doesn't matter if the volatility is 8 or 60. If it's low relative to itself or high relative to itself, that's what we care about. So, you know, start looking into that. If this is a really foreign concept to you, it's a foreign concept to everybody when they first hear it. So no worries or anything about that. Start, I'll tell you what, for those of you who want to master option trading, which I'm thinking is probably everybody here, otherwise you wouldn't be here investing this time into yourself, right? If you want to really master option trading, master the Greeks and master volatility. And that's not going to happen overnight. You're not going to go find one YouTube video that, you know, clears it all up for you in 5 minutes. I spent the last 45, almost 50 minutes here giving you everything that I could give you on this. And, you know, like there's a lot to it. Get comfortable with it. Look at one thing at a time. Start learning to use volatility charts to analyze volatility. Start looking at your delta, theta, vega, and gamma on every one of your trades. Set up your option chain like this, where you have implied volatility, delta, theta, and vega in it. I don't know if you necessarily need gamma in there, but you definitely want to have implied vol, delta, theta, and vega in your option chain. Start looking at them on every single trade, right? Just start slow, and over time with repetition, you'll learn more about it. The light bulbs will go off. You'll get better with them. You'll make better decisions, and you'll set yourself up for success. Juliet says, should I sell an option if implied volatility is high? So, right, a great question. This is where it gets a little bit tricky, right? Because what does high mean? Well, in this case, I would say high means like overpriced. But sometimes implied volatility rises like for a good reason. For example, going into earnings, right? Going into earnings, implied volatility can rise very high. Then it's high, but it doesn't necessarily mean it's overvalued. We don't tend to, I mean, unless you have a very specific system, most traders don't like to sell options going into earnings, because if there is this really big move, you can lose a lot, right? If you put on like a call credit spread the day before earnings, you might be selling this really high volatility, but you also have that negative gamma, right? If there is a big move to the upside, you can end up hitting your max loss that day. So should you sell options if implied volatility is high? You should sell it if it's overpriced. And again, in 2 weeks, we're going to have a whole webinar dedicated just to this. I've got so many things that I want to share with you that I want to pack in. And so keep these questions going, keep those wheels turning. And I'm going to cover all of this in the time that Tony has given me to share with you guys. All right. Lewis says, is implied volatility the same as IV percentile or IV rank? They're related. So implied volatility is, this number, right, that measures how cheap or expensive options are. What implied volatility percentile or rank, those two names are synonymous. That is like, remember I was giving you the example of like, there's this sort of like mean or average volatility. And when it gets lower, it tends to go higher and revert to it. When it goes higher, it tends to go lower and revert to it. Well, if the implied volatility is the lowest it's been in the past, let's just say year, most platforms use a 1 year period. If it's the lowest it's ever been in a year, it's at the 0 percentile or the 0 rank. If it's the highest it's been in the last year, it's at the 100th percentile or the 100th IV rank. If it's pretty much smack dab in the middle of where it's been in the last year, it's at the 50th percentile, the 50th rank. So a lot of folks will use IV percentile to just to have a number. So you're not just eyeballing a chart saying, oh yeah, okay, it's higher, it's lower. No, you're like using an exact number to say, oh, it's this much lower. It's the 30th percentile, so it's 20% below the average, right? Very good, insightful question. I love that you're even familiar with that stuff. Steve says, is the theta value shown the estimated decrease in the value in the next 24 hours? Because theta is multiplied by days to expiration, doesn't add up to the current market value, right? So yes, Steve, and I would even go a step further and say it's not the estimation, it literally is in mathematical and theoretical terms, the value that it will lose in a 1 day period, okay? Now, you're very right, and I love this. You asked that great, insightful question before, and this is another great, insightful question. So there's a couple of reasons why. So you look at this, if there's 14 days left, 10 cents times 14 days is $1.40, but at expiration, if these are still out of the money, they'll be worth 0. This implies that they're only going to lose $1.40 over between now and expiration, but they're worth $2.77. There's a couple of things going on here. I mean, first, if you want to really split hairs, it's not really based on the bid or the offer, it's based on the theoretical value, which is the midpoint. The other thing is, and this one, you, Steve, are going to go, ah, or maybe, aha, or maybe just the proverbial light bulb, because as soon as I tell you this, that's what's going to happen. This is a near the money option. So as time passes, as this goes from 14 to 13 days, 13 to 12 days, 12 to 11 days, guess what happens to the theta? The theta gets bigger. It gets bigger than 10. So that's how this ends up catching up to ultimately decaying down to 0 in time value. Good one, right? Isn't this great? That's why I threw in that slide on, dynamic inputs, right? Because that stuff's super important to really, if you really want to understand this stuff's super important. Jamie says, can you explain the plus and minus sign in front of the gamma, theta, and when I'm doing a spread, what do they mean on a long or short position? Yeah, to me, it's so confusing. I mean, it does make sense when you think about it, but if it was up to me, if I were king, I would get rid of those negative signs altogether. But I do see why they put them there. Basically, as far as theta goes, the one thing that you need to know is theta, the negative sign just means that as one day passes, you subtract the value of the theta from the options. It's minus, right? Negative. So if I buy options, I'm losing, right? If I buy options, I'm minusing 8 cents every day. But if I sell options, the options are getting worth less. So that means my profit is 8 cents a day, because you think about it, if a sell position would have a negative sign in front of it, right? If I sell 5, I'm short 5, I'm negative 5 contracts times a negative theta. 2 negatives make a positive, right? Well, if I multiply 2 negatives, they make a positive. And then gamma, the same thing. If I buy, options, I'm getting positive gamma because it's positive sign. But if I sell 5 contracts, like that's minus 5 contracts times gamma, I'm getting negative gamma 5 times that value. And then of course with delta, if I buy calls, I'm getting positive exposure. It's like being long 50 shares, right? But if I short 5, some of these calls, it's like getting short deltas. So a negative sign in front of the position times the positive gives me a negative sign. And then that's why they have the negative sign in front of the puts, because if I buy these, it's like being short. If I sell these, it's like being long. Once you think about it the right way, it makes sense. But I see exactly where you're coming from, Jamie. It is a little bit counterintuitive in some ways. Mark says if the delta is 0.20, that means there's a 20% chance of the option expiring in the money. However, since the delta is constantly changing, is that really accurate? Well, exactly. Well, here are 2 things. First of all, know that, just be aware of the fact that that is not mathematically accurate, right? Like any options mathematician will tell you that. It's only an estimation, a rule of thumb. That said, as accurate as that can be, it is accurate at that very moment in time, right? Because delta changes if the stock goes up or down, if time passes, or volatility changes. Once those things change, we can think about it as the chances of it expiring in the money change, right? It's like if you're watching a horse race, right? You're watching a horse race and your horse is really far behind and you're like, oh man, well, looks like I'm gonna lose. I better rip up this ticket. And then all of a sudden you see your horse pick up speed and you're like, wait a minute, maybe he is gonna win. I'm glad I didn't rip up that ticket, right? It's kind of the same with options. Right now, there's a 20% chance, but if it moves closer to the money, if volatility changes, maybe my chances improve. Good question. You guys are awesome. You guys are asking really fantastic questions. Steve says, do you look at the ratio of theta to Vega as a factor when shorting an option? No, I don't. I don't believe that that's valid, for the pure simple reason that if we're looking at that relationship on like a $17 stock like Ford Motor Company versus a $3,500 stock like Amazon, it's going to be completely different. The at the money of both of those is going to be about 50, but the theta on Ford is going to be tiny compared to the theta on Amazon. So it's not really a very good factor to use. Carlos says, is there a calculator we could use when analyzing a trade? 100% absolutely. Look at the stuff on OptionsPlay. OptionsPlay, like on the main screen, I think it's called the dashboard, in the bottom right-hand side, like it's got everything you need. It's got everything you need right there. And most options-friendly brokerage platforms also supply all this stuff. Like, look, they give you the delta, theta, Vega right there in the options chain, and you can even model it out. If we have time throughout the month, that'll probably work its way into one of our presentations and how to model that stuff out. So, yep. But start with OptionsPlay. Tony says, can you walk through an example of a particular strategy using the Greeks? Yeah, I mean, I did walk through, you know, a few. Let's see how we're doing on time. What time did I start here? 3:50. Oh boy, so I've been at this for about an hour and 15 minutes. So Tony, I did give some examples. If you get a chance, go back and review the recording and take a look. But there's a lot of different examples, and just the more you familiarize yourself with this, the better. Sandra said, I thought Tony said you were doing OptionsPlay webinars on Wednesdays, not today. Is next week's webinar going to be Tuesday or Wednesday? Next week's is going to be Wednesday. So yeah, Tony's right. Unfortunately, or well, fortunately, I'm actually headed out of town tomorrow for a little mini vacation, if you will. So I had to do this one Tuesday. So thank you for being able to adjust your schedule and attend today. Steve, I kind of talked a little bit earlier about the IV rank and percentile, and I'm going to talk about that in a couple of weeks too. So for the sake of being over on time here, I'm going to let that one go if you don't mind. Is there an example of how you construct a short string? Anonymous, it's a little bit out of the scope. If we weren't really over on time, I'd take it, but I'm not able to. I'm sorry about that. You know, the math equation. Yeah, so Alex, the math equation for calculating the price of an option using delta and gamma, ignoring time and volatility, is just this. Like, let's say I buy these 145. Well, I'm going to stick to delta because the gamma, adding gamma to it is a lengthier explanation. But if I mean, it's just basically definition, right? If I think that the stock is going to go up 50 cents, I'm going to take 50 cents, 0.5 times 50 delta, which happens to be 0.50 also. And that's going to be 25 cents. So if it goes up, like all I do is I multiply the change in stock price times the delta. I mean, gamma works its way in there too, knowing that if like if it goes up by 50 cents, I would multiply 50 cents times 0.57. That's going to give me, you know, 0.027 or 0.026 or something like that. I don't know. It's hard to do math in your head when you're doing webinars. But that means that I know that the delta is going to increase by half the amount of this gamma, you know, 0.027. And so I'm going to basically add that to the delta, but because delta starts at 0 and ends, you know, higher by a little bit more, it's a little bit more of a complicated equation. So in the spirit of being over time, I'm going to kind of stop it. Ashok says, thank you, Dan. Outstanding. You're welcome, my friend. I really appreciate that. Thank you very much. If you're selling covered, Tony says, if you're selling covered calls but want to keep the underlying from being called away, how do you pick your strike based on the Greeks and expiration? Yeah. So, I mean, one thing you can do is you can use delta as an estimation of your likelihood of being assigned. Right. The other thing you can do is you can say, well, you know, how much do I lose on delta if the stock goes up versus how much do I make on theta as each day passes? So, you know, if it goes up, you know, $1 over 3 days, is that okay? Am I making or losing money? So you kind of do that balance between delta and theta. That's the short answer. While you're filling in for Tony, would you give a rundown on how I personally use Thinkorswim? Oh man, I use it a whole bunch of different ways. But you know, that'll come up. I mean, I don't intend on my webinars to be a demo on Thinkorswim, but you know, just some of those things will come up as time passes here. When I do a short put spread, how do you calculate the value of my net deltas and my net thetas since I'm adding and subtracting negative numbers? Right. So think of it as if it's a put credit spread, if I'm selling these puts, I'm getting, so right, I'm selling these, so I'm getting positive theta because it's a negative position times a negative theta gives me a positive theta. And I'm buying these, so positive position times a negative theta gives me a negative number. So basically I'm just adding this positive number to this negative number. Is there a linear mathematical relationship between underlying decrease and IV increase? Lauren, there's a whole bunch of math that goes into that, like regression lines and all that. But Phil, oh, good. Oh, thank you. I appreciate it, Phil. Thank you very much. And Mark, thank you also, my friend. You're welcome, and thank you for spending your time with me and just entrusting me to help provide some value. All that being said, everyone, thank you for spending your time with me. I look forward to the next 3 or 4 presentations that we have together while Tony is out spending time with his new family, and can't wait to share some more thoughts with you next week. Trade well.